Hello, welcome back to the Research Analyst series of NISM. In previous chapters, we were covering the definitions and terminologies. So let's start from chapter 2.2.4 Indices. A market index tracks the market movement by using the prices of a specific number of shares chosen as a representative sample. Most leading indices are created by a market capitalization to take into account the fact that the more number of shares issued, greater the number of portfolios in which they may be held. Stocks included in an index are also quite liquid, making it possible for investors to replicate the index at a low cost. Narrow indices are usually made up of the most actively traded equity shares in that exchange. Other indices to track sectors or market cap categories are also in use. The most widely tracked indices in India are the NSE's Nifty 50, S&P BSE Index, Sensex, and MSCI's SX 40. The S&P Sensex has been computed as the market cap weighted index of 30,000 stocks from the BSE. The SX 40 is composed of 40 most representative stocks listed on Metropolitan Stock Exchange of India Limited. MSCIL, and the Nifty 50 is composed of 50 most representative stocks listed on the National Stock Exchange. The shares included in these indices are chosen on the basis of factors such as liquidity, availability of floating stock, and size of market capitalization. The composition of stocks in the index is reviewed and modified from time to time to keep the index representative of the underlying market. Some of other common indices in India are listed below: Nifty Next 50, Nifty 100, Nifty 500, S&P BSE 100, S&P BSE 500, S&P BSE Mid Cap, and S&P BSE Small Cap. There are also sectors indices for banking, information technology, pharma, fast-moving consumer goods, and such other sectors created by the exchanges to enable tracking specific sectors. The major uses of indices are the index can give a comparison of returns on investments in stock markets as opposed to assets classes such as gold or debt. For the comparison of performance with an active equity fund portfolio, a stock market index can be the benchmark. The performance of the economy or any other sector of the economy in a country is indicated by the index. Real-time market sentiments are indicated by indices. Indices act as an underlying for index funds, index futures, and options. Next term we have is mutual fund units. So these are issued by mutual funds. The investors are institutional and individual. The medium is direct issuance by mutual funds and stock exchange. Regulatory is SEBI. Mutual funds are investment vehicles that pool together the money contributed by investors, which the fund invests in a portfolio of securities that reflect the common investment objectives of the investors. Each investor's share is represented by the units issued by the fund. The value of the units called the net asset value changes continuously to reflect changes in the value of the portfolio held by the fund. Mutual fund schemes can be classified as open-ended or close-ended. An open-ended scheme offers the investors an option to buy units from the fund at any time and sell the units back to the fund at any time. These schemes do not have any fixed maturity period. The units can be bought and sold anytime at the NAV-linked prices. The unit capital of closed-ended funds is fixed and they sell a specific number of units. Units of closed-ended funds can be bought or sold in the stock market, where they are mandatorily listed. The next chapter we have is exchange traded funds or ETFs. These are issued by mutual funds. The investors are institutional and individual. The medium is direct issuance by mutual funds and stock exchange. The regulator is SEBI. So exchange traded fund or ETF is an investment vehicle that invests funds pooled by investors to track an index, a commodity, example gold, or a basket of assets. It is similar to an index fund in the sense that its portfolio reflects the index it tracks. But unlike an index fund, the units of the ETF are listed and traded in demat form or a stock exchange, and their price changes continuously to reflect changes in the index or commodity prices. ETFs provide the diversification benefit of an index fund as well as the facility to sell or buy at real-time prices. Even one unit of the fund. One unit of the fund, since an ETF is a passively managed portfolio, its expense ratios are typically lower than that of the mutual fund scheme. The next term we have is hybrid structured products. So we will cover this term in the next upcoming videos. So that's it for now. Thank you.